Hey everyone, and welcome to Cash Out. This is going to be my new weekly episode TV show that is going to recap whatever happened last week and look into the future and predict what's going to happen next week. The reason I'm starting this show is a couple of reasons. One, my mom and I were talking, and she said, "Boy, your TikTok channel is really catching on, and it's too bad TD Ameritrade or CNBC doesn't see you and give you some sort of weekly webisode." And I was like, "Yeah." And she was like, "Yeah." And so I'm thinking, and I said, you know what? I got these studio lights here. I got a fancy microphone. I even have this push button remote start thing. I can do it myself. It would be cool, but I don't need them. I can do it myself. I could start my own little weekly episodic TV show. So here it is. Cash Out, like I said, is just gonna recap what's been going on, look to the news of the following week, and answer some of your most burning questions that I got on TikTok. If you follow me on TikTok, which you should be, the majority of the questions I answer are, it's TikTok. You got 1 minute, 60 seconds. So I feel like a lot of the time I'm rushing through these really good questions and I'm not getting to the meat of it and answering more in depth. So Cash Out, my new weekly TV show. I'm going to post a new episode every Sunday. It's going to be maybe around 10 or 15 minutes per episode. And I'm just going to do a little recap, talk about what happened, talk about what will be happening, and answer your questions a little more in depth. If you don't know me or are not familiar with my story, I will link below to the whole how I got started trading kind of story. But very, very quick, I just wanted to be a professional wrestler. That's all I ever wanted to be. And when I was 18, I went off to a school. I got injured. I broke my back. And I had no plan B. There was nothing else I wanted to do. So I worked in the restaurant industry. I worked in the fitness industry. I had these little side hustles all along the way, whether it was books or an online minimalist magazine or t-shirt company. And all those little teeny things kind of, even though they failed in the moment, were setting me up to do something else, which I kind of realize now was this whole TikTok journey has been incredible. So if you want to know more of my origin story, I'll link that stuff down below. But I wanted to get into it. I am self-taught. I don't know everything. But I think one of the things that I wish I had 10 years ago when I was first starting out trading and investing was someone like me that I could look to and say hey, I want to do what you do. Can you help me along the way? And that's one of the reasons I don't sell a course, because I'm not trying to take money off of people who just want a better tomorrow or whatever. I don't need it. So that's why I don't do it. Anyway, enough with that. I wanted to hop into two big stories, one from last week and one from next week, and address both of them. The first, I want to talk about what's been going on in China, because I have a lot of followers on my TikTok page who are invested in Chinese stocks. I'm talking about stuff like NIO, stuff like Alibaba, stuff like Baidu, stuff like Luckin Coffee. And when this whole new law passed last week, a lot of these followers messaged me and said, "What do I do? Should I sell my stock? I'm freaking out. I'm panicking. My company's going to get delisted." And I said, "Hey man, hold on." So first of all, let's talk about what it means for a company to get delisted and why that would happen. If you are a penny stock or a stock that is going down in value, one of the things that you have to do if you want your stock to be listed on one of the major indexes like the Dow, the New York Stock Exchange or the NASDAQ, is your stock has to be above a certain price. So a lot of times you'll see a stock that's just getting hammered and it goes into penny stock territory. And if that stock can't get back over, say, $1 within a set period of time, they get a notice that they're going to be delisted. They have to get that stock price up over $1, or they're moved off of that big prominent index like the NASDAQ or the New York Stock Exchange, and they're moved to something called the over-the-counter market. You might have seen it called OTC. That's where penny stocks go and live. It doesn't mean that the stock disappears. It doesn't mean that the stock stops trading. It doesn't mean that you don't have access to your funds if you need to sell it. It only means that your stock is no longer listed on a prominent exchange, and because of that, there might not be many buyers available or sellers available. So if you're looking to buy, you might not be able to get it at the price you want. If you're trying to sell, you might not be able to find any buyers at the price you are currently asking. The bid and the ask will have a very wide spread. So you might be on there going like, I'm trying to sell my stock at 89 cents. Why isn't it going through? It's because there aren't a lot of buyers, and the only people who are looking to buy are maybe trying to get it at, say, 75 cents. That's a concern. But that's for penny stocks. This is more of like a slap on the wrist, right? These stocks won't cease to exist. You won't still be able to trade them. It just means that they're going to be moved off of the prestigious index onto something like a penny stock, over-the-counter pink sheet. I would imagine that some prestigious or very well-to-do hedge funds will unload their positions because it doesn't probably look good on their portfolio list to say like, here are the companies we've invested in, and one of them is trading on the penny stocks, pink sheets. So I could see that hurting, but let's first of all look at the big picture here. These companies are being given 3 years. And in that 3-year period, they have to allow our auditors to examine their financial records. If they then refuse to do that, they face getting delisted. So this isn't something that's happening tomorrow. Alibaba is not going to be delisted tomorrow. This is something that they are giving China 3 years. You've got 3 years to get your shit in order and allow our auditors to examine your finances. If you don't, you face delisting. Like I said, you'll still be able to trade these stocks. They won't go away. If you have stock in Alibaba or Baidu or Neo, it's not going to be gone forever. You're not losing 100% of your money. You don't have to panic and sell. This is a hot in the moment story, which is the point of Cash Out. That's the point of this show, is to talk about these hot in the moment stories and say, look, when this news came out, a lot of Chinese companies got hammered. They went down. It's a story. People short these stocks. They make money off of it. They dump their positions because they panic because they don't know any better. And then, look, this is going to be a 3-year thing. So in 2.5 years, this is going to become a story again. It's not a major concern here and now in the moment. It's just something as an investor that you might want to keep an eye on if you have these companies. You might want to start taking some profits if you're nervous, if you believe that the company might say, hey, we've got nothing to hide. Take a look at our records. Sure. The next question is, why hasn't China been doing this in the first place? China says that they have a lot of secret laws that prohibit them from sharing their information with us. That's why they say they don't do it. Why we haven't been tough on them in the past, I don't know, but it seems like we're getting tough on them now. And, at the end of the day, if you want to be listed on our exchanges, you have to play by our rules. And China likes the clout that comes with being listed on a U.S. exchange, right? It looks good for them to say, my company, my corporation is listed on a U.S. stock exchange. Wow, that's significant. So I would imagine that some of these companies will probably say we've got nothing to hide. And some of them will say, no, I don't want them seeing our records because we've been lying. Case in point is Luckin Coffee. Luckin Coffee is like the Chinese Starbucks. And when this company got onto the U.S. exchange, people started gobbling up shares because they were like, yo, this is the Chinese Starbucks. It's the next big thing. I'm going to get in early. And the stock had a meteoric rise up to around $50 a share. And then a scandal broke. And the scandal was that they were lying about how much they were worth or how much they were profiting or something like that. They were lying about their numbers. 300 million was what they claimed that they had made, either in profits or revenues or some shit like that. And the stock got hammered because they were lying, because U.S. auditors weren't allowed to inspect their finances that potentially would have caught this. So a lot of U.S. investors got really, really hurt because they bought at 50 thinking, I'm getting in early on the ground floor of this mega Chinese corporation. China doesn't really do coffee, right? They're a tea country. And Starbucks is there, but a Chinese company selling coffee to a humongous population, billions of people. Wow, Luckin Coffee could be huge. So people started getting in thinking $50 is pretty reasonable for a company that's new and is already crushing it and making so much money. When the word got out, the stock tanked and crashed. People got really, really hurt. So this new law hopefully aims to prevent something like that. That's why it's happening. And now on to the big story of next week. So we've got some big IPOs coming. DoorDash will go public, and so will Airbnb. I don't know if they're both going public next week, but one of them is going public on Thursday. I can't remember which it is. The question that I was getting asked a lot on TikTok is, should you buy these IPOs? An initial public offering is when a stock goes public for the first time. So it goes from being a private company to a publicly traded company. One of the things that you'll notice if you watch these IPOs on the day that the company starts trading publicly is if you have CNBC on that day, on that Thursday, you'll notice that they say like, oh, this company is going to go public at like 11:30 in the morning. And what ends up happening is as we get closer and closer to 11:30, they start delaying it. Oh, now it's going to be going public at 11:45. Oh, now it's going to be going public at noon. And the reason is that these underwriters, the people who are helping the banks, the big banks who are helping this company go public, are listening to the other banks, the other institutions, hedge funds, and that sort of thing, and they're seeing how much demand is out for the stock. So one of the things that you'll often hear when you watch these IPOs go live for the first time is the guy from CNBC is sitting down on the floor with like the thing in his ear, the thing, and he's going, oh, the company was going to go public at this price, and now it's let's say $60. Now it's $60.50. Now it's going to be opening at $60.50. Oh wait, what's that? $61. Now it's going at $61 because all these hedge funds, all these institutions, and all these very, very super wealthy investors are going, no, I want some too. So they're driving up the price. So they're readjusting the price over and over to get the very best price, make the most amount of money that they can for the company that's going public. In this case, Airbnb and DoorDash. So I imagine that will be the same. So the big question that I was getting asked is, should I buy these stocks? Here's the thing. If you're day trading an IPO, it can be wildly volatile and very, very risky. Of course, there's going to be money to be made, but there's also huge amounts of money that can be lost if you're being stupid and just gambling. One of the things that happens is when the stock finally does go public, it explodes and it just starts flying. So if you, the investor, are sitting there going, oh, I want to get in, and let's say it's $60, and you go to put in a trade at 60, but so many orders are coming in that before you even finish your trade, it's 63, and you're like, shit. So you go to revise your order. Now you can always buy market order, which just says I want to pay whatever it's going for, but that could be way more than you were expecting, especially in a very wild and chaotic IPO. So you go to revise your order. Okay, 63. Oh, 65. Oh, now it's 67. At the end, when your order finally goes through, it's potentially that you've bought at the very tippy top, and then the people who got in early, who were lucky to get in at the lower price, are now trading and selling their huge amounts of shares. Stock is going up, stock is going down. It can be risky, and you can get wiped out on these IPOs. You can end up having a huge loss if you're just day trading. If you're looking to invest in these companies, again, I would still urge you to be cautious on these IPOs because of the swings can be so volatile and so wild. One of your options would be to scale in a little bit. If you really believe in one of these companies, you really like it, you can buy a little bit on the IPO day, wait to see if there's a pullback the next day, usually profit taking. There's also something called a lockup period, which usually expires 60 to 90 days. So the underwriters, the banks that help take this company public, and the executives in that company are prohibited from selling their shares for a set period of time. Usually it's 60 to 90 days. When lockup expires, they all sell because they want to cash out. They want to make their money. So that's another thing you need to be cautious of. You can always, but the stock might continue to rise up until that lockup, and then when it sells off, it still is dramatically higher from where it went public. So there's so many things to consider. Now, should you buy DoorDash or Airbnb when they go public in the week or weeks to follow? Here's the thing. When you're looking at a company like DoorDash, they've got a lot of competitors. Uber, Postmates, Grubhub. There's probably others that I don't know off the top of my head. You can also get your groceries delivered from Whole Foods. Whole Foods has prepared meals, although it's not the same, but it's sort of. DoorDash has a lot of competition. And the other thing that you're probably not considering is right now, DoorDash is probably the stock to own because of coronavirus. Nobody's able to go to restaurants. Everyone's ordering out. Everyone's getting delivery. So DoorDash, if they were a publicly traded company for the last several years, would probably be posting record quarter earnings, and their stock price would be skyrocketing right now. But they're not. So you're buying in on this stock right at the perfect moment for this company because look, man, I live in a building full of 300 units, and there's people downstairs every day waiting at the front door for their DoorDash delivery. You know, that might change when COVID is behind us, everyone's been vaccinated, and the restaurants are open again for business where you can go and eat out in an actual restaurant. Maybe DoorDash over the next couple of years when coronavirus cases drop, maybe their business might drop as well. On the other hand, we've got Airbnb, which is going public. But who's going anywhere? Not a lot of people are traveling. But, so for DoorDash, now is the most opportune time because everyone is stuck at home and everyone's ordering. It's funny because they're so different, but they're kind of similar in the ways that they're being affected or not affected by this virus. Airbnb is the flip side of that, where nobody's traveling. Nobody's really going anywhere right now. So if Airbnb had already been a publicly traded company and they were posting quarterly earnings right now, their stock might be getting hammered because they might be saying, well, because of COVID, nobody's going anywhere. But when COVID ends, unlike DoorDash, which might see a slowing, Airbnb might see a rising. So as a long-term investor, Airbnb might be a stock that you're interested in buying. But again, I would caution you on the IPO day to be careful. If you are really a long-term believer in this company and you just have to have it on the IPO day, you can. But these markets are super volatile and there's no predicting. That's the thing about these IPOs is there's no way to predict. You could look at one IPO that just went bananas and went up and never came back. You could look at other IPOs that tanked and then went way up. Each one is different. If you have anxiety about it, like you don't want to miss out, you can always scale in, buy a little bit, have a little skin in the game, wait and see, oh, it drops lower the next day or in the next weeks or in the next months, get a little bit more. And of course, you can always buy more as the stock goes up too. There's no shame. Everyone is so hooked on buy low, sell high, but don't forget that buy high, sell higher is also a thing, especially with momentum stocks, as these I might imagine would be for various reasons, right? DoorDash is probably going to be having a lot of momentum behind it when they go public right now because of COVID, and Airbnb might pick up some steam down the road when COVID ends and people start traveling. So let's wrap up this episode of Cash Out. It is the first episode of what is hopefully going to be a new episode every Sunday, where I will look at the last week's story, the next week's story, answer some of your questions. If you like this, if you're interested in Cash Out, if you like the show, please subscribe, hit the little bell, hit the notification so you get alerts for when I do new episodes. And by the way, if you like my tutorial videos, my walkthroughs, my technical analysis stuff, I'm still going to be doing those too. Cash Out is just something new I'm going to be doing every Sunday. Thanks for watching and have a good day.